Hi, it's Ewan here. I'm going to do a video today on how to manage your risk when you've got a small account. So I've had a lot of people asking me recently, how do I get the kind of slow risk levels that you need when my account's so small? And people seem to be limited by position sizes by brokers. I just want to go through a position I put the other day just to make sure people are doing it right. And then I'm going to talk about the effect of actually increasing your position size and what that does. So first off, this is an oil position that I flagged on Monday. And so we've got order 52.28, 50.56. Now, just want to go through how I would do this. Imagine I had $1,000 account, so I want to be risking about 2%. So that would be $20 risk. Now, what I would do is I would go straight to times 25, $25, and actually that's the perfect amount. So $20 risk by using $25 and times 25 leverage. Now you can do this a lot of ways. I've actually just written a blog about how to use margin and leverage to control your risk, and how a lot of people think of these the wrong way around. So people think in terms of what their leverage is rather than what their risk is, and that's just the wrong way to do it. So if you look here, I can achieve the same effect of risking $20 by using a times 5 leverage and then going 125. So once you've determined our stop loss and we know our risk, then this leverage is just a tool that allows you to optimize your equity to get this risk. So we don't want to be thinking in terms of leverage. We want to be thinking in terms of what leverage can I use to get my risk. And there's a lot of ways to do this. I could even go times 1, and I don't think it's going to let me do this because I don't have an effect here. 675, yep. So same effect. I'm still exposed by $625 as we look here. So my exposure is 625 no matter which way I do it. And this is the way to be thinking about it. Now, to people who seem to be having an issue where their position size is too low, I'm not sure whether that's specific to them, because I can actually go as low as $25 exposure here, which would be 80 cents risk. Now, unless your account size is lower than $40, this should be about 2% of your account, and you should be able to do, you should be able to get this. So people have been asking me as well, because I can't get the 2% risk, should I tighten my stop loss, or should I be increasing my risk? Now, addressing the first issue, we don't want to be tailoring our risk to our stop loss. We don't want to be tailoring our stop loss to our risk, because if we're just closing at some random price because that's what our stop loss says, then there's no real reason why our stop loss is that width. It's kind of just pulled out of nowhere because that's what we could get our kind of minus $20 at. So we want to have our stop loss first, and then we want to adjust our risk to our stop loss, and that's the way around to do it. You want to know where your exit is. You want your exit strategy to be decided, and then you want your risks to be adapted to that. And addressing the second issue as to whether people should just be risking maybe 6-7% so they can get their stop loss. I just want to go through the effect that increasing your position size has, and the way to do this is to just go through the way I want to do this is to go through my back test. So what I've got here is kind of the basis of everything I do, and if I just quickly show you this spreadsheet here, might look very boring, lots of numbers, but this is the kind of foundations as to why I do everything I do. So if you understand this, then hopefully you'll understand the thought process a little bit more. So what I've got here, if it loads, it's a very, very big spreadsheet. Here we go. So just crashed a little bit. So what I've got here is these are all the dates, and these are the kind of rules that I follow, and these are the rules I signal as well. So what this is doing is telling me, okay, if I was following this strategy for the last 20 years, how much would I make? So I'd be kind of selling here, then I'd be closing, would I be stopped out? And this is calculating this all for me. So there's about 30 markets in here from 1999 up to 2016, which makes 107,000 rows. So it's pretty big. It's a pretty big test, and there's about 2,067 trades, and I've done a lot more testing than that as well. So this is the kind of raw data, and what this is doing over here is this is turning that data into an equity curve. So if we had put all those markets side by side and we were trading them at the same time, then kind of what would we end up with if we started $10,000? And this is a result. You can see I've got a position size of 2% here, and that gives us an average compound growth rate of 86% over those 16, 17 years, and it gives us a maximum drawdown of 36%. So that turns 10,000 into 78 million over a 16-year period. So that's with 2%. Now, if we look at what happens if we change this to 7%, so this is what people have been asking me, should I increase my risk to say 7% because I can't get my stop loss? Now, if we just recalculate this sheet and see what happens, you're going to see that this system goes from a very kind of medium risk, long-term, sustainable approach to something that's very unsustainable, very high risk, and you can just see the effect of how much a small, seems like a small kind of change in your strategy. I'm just going to increase my risk from 2 to 7%, just for this one trade, has a very profound effect on the performance. And if you're at the stage where your account is so low that you can't afford the 2% risk, then you're still in a stage where I was a couple of years ago, and I've talked about this a lot in my story, where you're at the stage where you're learning how to trade still, and you're learning how to manage risk. So your priority needs to be staying in the game, learning how to trade, and making sure that you're doing everything right, so that when you do have a big account, you're going to be making consistent money and you're not going to blow it. So I'd work towards trading well and building up your equity, and then it will come naturally that your account will grow, and then you'll be able to trade all the markets you want to trade. So if you have to sit out of a trade because you can't manage the risk, then that's what you have to do. Don't try and increase your risk and risk blowing your account and having a huge drawdown because of that. So yeah, you can see the drawdown goes to 108%. This graph hasn't updated properly yet, which means at some point your equity is going all the way to 108, which means you've blown your account. So if by increasing your position size to 7% here, you actually blow your account entirely. So just wanted to discuss that today because I've had a lot of questions about this week, and my opinion is that you should be focusing on managing your risk as a priority, so that you can stay in the game and you can catch all the other trades, and don't start tailoring your risk so that you can kind of fit with these rules that have been set out by the brokers, so that you need to kind of have a minimum position size, because your priorities still needs to be trading well and performing well. And then once you've got the confidence that you can do that consistently, then you'll be able to increase your account size, and then you won't have those issues anymore. So hopefully that's cleared up that kind of issue that I've been asked a lot this week. And thanks for watching. Let me know if you've got any more questions.